What if you invested just $1,000 30 years ago? What if, on a completely ordinary day, you made a simple decision that didn't feel important at the time? No complex strategy, no deep financial knowledge, just one small step. You took $1,000 and invested it into a company you already knew. Not a risky startup, not a trending stock, just something familiar, something you've seen your entire life. Now imagine this. You didn't touch that money for 30 years. No checking the price every day. No panic during market crashes. No jumping in and out. Just patience. Today, we're going to explore what would have actually happened if you had invested that $1,000 into Coca-Cola around 30 years ago, and more importantly, what this simple example teaches us about how wealth really works. Let's go back to the mid-1990s. The world looked very different. There were no smartphones, no social media, no constant financial advice in your pocket. The internet was just beginning. Most people weren't thinking about investing at all, but Coca-Cola was already everywhere. It wasn't new, it wasn't risky, it wasn't unknown. It was one of the most recognized brands in the world. From small local shops to global cities, Coca-Cola had built something powerful, a product people kept buying again and again, and that matters because the best businesses are not always the most exciting ones. They're the ones people consistently come back to. Around that time, Coca-Cola stock was trading at roughly $12 per share, adjusted for splits. So if you had $1,000, you could buy about 83 shares. That's it. No timing the market, no special skills, just ownership in a real business. Now let's fast forward. Over the next 30 years, the world changed dramatically. Markets went up, markets crashed, and then recovered again. There was the dot-com bubble, the 2008 financial crisis, and even the COVID crash. And through all of that, Coca-Cola kept doing the same thing, selling products, generating profit, expanding globally. Not fast, not dramatic, just consistent. Today, Coca-Cola trades at around $60 per share, so those 83 shares would now be worth roughly $5,000. That's about a 5 times return. It sounds good, but it's not extraordinary, and this is where most people stop. They look at the price growth and think that's the whole story, but it's not even close, because Coca-Cola didn't just grow, it paid you every single year. This is where everything changes. Coca-Cola is known for its dividends. A dividend is simply a portion of the company's profit paid directly to shareholders. In simple terms, you own the business and the business pays you. Coca-Cola has increased its dividend for more than 60 consecutive years. That means even during recessions, even during financial crises, it kept paying investors. Back in the 1990s, the dividend was small, maybe around 30 to 40 cents per share annually. So your 83 shares wouldn't generate much at first, but every single year that dividend increased, slowly, quietly, consistently. Today, Coca-Cola pays around $1.80 per share each year. So your 83 shares now generate roughly $150 annually, passive income without selling anything. But here's where things become truly powerful. If you had taken those dividends and reinvested them, you would have bought more shares. Those shares would then generate more dividends, which would buy even more shares. This cycle continues year after year, decade after decade. This is called compounding, and it's one of the most powerful forces in investing. Over 30 years, that original $1,000 could realistically grow to $10,000, even $15,000 or more, simply because you stayed invested and let the process work. And this result wasn't luck. It worked for a reason. Coca-Cola has a strong business model. It sells a product that people buy repeatedly. It has strong brand loyalty. and it operates globally. That creates stability. The company generates consistent cash flow, which allows it to pay dividends, reinvest in growth, and survive downturns. But most importantly, it had time. 30 years gave your investment time to grow, time to recover from crashes, and time to compound. And this is where most people fail, not because they pick bad investments, but because they don't stay invested long enough. Here's the uncomfortable truth: this opportunity was never hidden. Coca-Cola wasn't some secret stock. It was everywhere. It wasn't complicated. It wasn't risky. It wasn't hard to understand. It was obvious, and yet most people didn't invest. Why? Because it looked too simple, too slow, too boring. People chase fast money, quick wins, and exciting opportunities. But real wealth is often built quietly through patience and consistency. So, what does this mean for you today? It means you don't need perfect timing. You don't need advanced knowledge. You don't need to chase trends or take huge risks. What you need is simple: a good business, a long-term mindset, and the discipline to stay consistent. Because somewhere right now, there are companies quietly doing the same thing Coca-Cola did, growing steadily, paying consistently, compounding over time. And the real question is not whether those opportunities exist. The real question is whether you'll recognize them or ignore them because they don't look exciting. Start small, stay consistent, and let time do the heavy lifting. What if I told you that the most powerful force in finance is not intelligence, not timing, and not even how much money you start with, but something far simpler, something almost invisible, something most people completely underestimate? It's called compounding. And once you truly understand it, you start to see money, time, and decisions very differently. Because compounding is not just about growing wealth, it's about how small actions, repeated consistently over time, can turn into something far bigger than you ever expected. Let's start with a simple idea. Imagine you invest $1,000, not a huge amount, just something realistic. Now imagine that money grows at 10% per year. After 1 year, you have $1,100. That seems small, nothing exciting, but here's where things begin to change. In the second year, you don't just earn returns on your original $1,000, you earn returns on the entire $1,100. So now your growth is slightly bigger, and in the third year, it grows again and again and again. This is compounding. It's growth built on top of previous growth, and over time, that simple shift changes everything. At first, compounding feels slow, almost boring. In the early years, the progress is barely noticeable. It doesn't feel like anything is happening, and this is exactly why most people quit too early. They expect fast results, they want visible progress, they want something exciting, but compounding doesn't work like that. It rewards patience, not speed. In the beginning, it looks like nothing is happening, but under the surface, something is building. Quietly, consistently. To really understand compounding, you have to understand time. Time is not just a factor in compounding, it is the main driver. The longer your money stays invested, the more powerful compounding becomes. Think of it like planting a tree. In the first few years, the tree is small. It doesn't provide shade. It doesn't look impressive. But over time, as the roots grow deeper and the structure becomes stronger, the growth accelerates. Eventually, the tree becomes something massive. But only if you let it grow. If you keep digging it up every year to check if it's growing, you destroy the process. Investing works the same way. Now, let's take this a step further. Imagine two people. One starts investing early, even with a small amount. The other waits, planning to invest more later. The first person invests $100 a month starting at age 25. The second person waits until 35 but invests double the amount. Logically, it feels like the second person should catch up, but in reality, the first person often ends up ahead. Why? Because time matters more than contribution. Those extra 10 years of compounding make a massive difference. It's not about how much you invest, it's about how long your money is working. Compounding doesn't just apply to investing, it applies to habits, decisions, and behavior. Small daily choices compound over time. If you save a little consistently, it grows. If you learn a little every day, your knowledge compounds. Even your health works the same way. Small habits repeated daily create long-term results. Compounding is a universal principle. It shows up everywhere once you start looking for it. But there's another side to compounding that people often ignore. Compounding can work against you. Debt compounds too. Interest on loans, credit cards, and missed payments can grow over time in the same way investments do. This is why some people feel stuck financially. They are not just dealing with a fixed problem, they are dealing with a compounding problem. And just like positive compounding builds wealth slowly, negative compounding can create financial pressure over time. Understanding this difference is critical. Now, let's bring this back to investing. One of the best examples of compounding in the real world is long-term investing in stable companies or index funds. These investments may not look exciting in the short term. They don't double overnight. They don't create sudden wealth. But over long periods of time, they grow steadily. And when you combine that growth with reinvestment, the effect becomes powerful. Reinvesting means taking your returns and putting them back into the investment, allowing the cycle to continue. This is how small investments turn into large ones. The challenge is not understanding compounding. The math is simple. The challenge is behavior, staying consistent, not quitting early, not reacting emotionally to market changes. Because compounding requires discipline. It requires you to trust the process even when the results are not immediately visible. And this is where most people struggle. They interrupt the process, they sell too early, they chase something else, and by doing that, they break the compounding cycle. Another important concept is consistency. You don't need to invest a large amount at once. Regular contributions, even small ones, can compound over time. This is why systems like monthly investing work so well. They remove the need for timing. You simply stay consistent, and consistency over time creates momentum, and momentum combined with compounding creates growth. Let's also talk about expectations. Compounding is not a shortcut to quick wealth. It is a long-term strategy. It rewards those who think in years and decades, not days and weeks. And this mindset shift is important because once you stop expecting instant results, you start making better decisions. You become more patient, more focused, more consistent. And those qualities align perfectly with how compounding works. One of the most interesting things about compounding is how it accelerates over time. In the early years, growth is slow. In the middle years, it becomes noticeable. And in the later years, it becomes powerful. This is why people who stay invested for long periods often see the biggest gains toward the end. It's not because something suddenly changed. It's because the compounding effect finally reached a point where growth becomes visible and significant. So, what does all of this mean for you? It means that starting matters more than perfection. You don't need the perfect plan. You don't need perfect timing. You don't need to wait for the ideal moment. What matters is getting started and staying consistent. Because every year you delay, you are not just losing time. You are losing the compounding effect that time creates. And this is the real lesson. Compounding is not about money alone, it's about understanding how small actions, repeated over time, create large outcomes. It's about patience, discipline, and consistency. It's about trusting a process that doesn't always give immediate feedback. And once you understand that, you stop chasing quick results. You start building something that lasts. Because in the end, compounding is simple, but it's not easy. It requires you to do the same thing over and over again without getting distracted, without giving up, and without expecting instant rewards. And that's exactly why it works, because very few people are willing to do it long enough to see the real results. Start small, stay consistent, and give it time, because time combined with compounding can turn almost anything into something powerful. If you found this helpful, consider subscribing for more real insights on money and investing.